All my life, I've been told that savings is the key. And now that I'm older, I now understand savings is not the key. When I was studying insurance at New York Life University, I had already had my insurance license, taking my continuing education and that sort of thing for about 7 years. But taking classes there changed my life. Here's the reason why. I learned the triangle. I now understand, because it's been true in my life, that a savings account is nothing but an emergency fund. An emergency fund for when you need cash. There's always, sometimes there's transition. So savings is for emergency funds. So in what you do is you take your bills, like my bills are right there on the wall, right there, and you times it by 6 at least, sometimes 12. Over 12 is too much. I'll tell you why in a minute. You take your monthly amount, you times it by 6 or 12, you put that into a savings account, and that's called an emergency fund. The reason why is because you can always experience a downturn. In an emergency fund, it's very liquid. That's a savings account. A checking account is different. A checking account is where the bills come out of. So you have a month's worth of bills there. I'll tell you why in a minute. So now we've covered the checking account and the savings account. Now beyond the checking account and the savings account, which is highly liquid, one coming from the other. In other words, so when money is earned, it goes into a checking account, right? And people have 401ks, 457s, and that sort of thing as well. Those are considered retirement accounts. So money is swept from your job to your checking account and to your 401k. That's called a retirement account, not an investment account. Investment accounts are accounts like E-Trade, where you put a certain amount of money out of from your system into, and then you buy stocks. Some people buy commodities. Some people buy gold, silver. Some people buy a combination of them all. Can't legally talk about those things. No, wait a minute. Yes, I can, because I don't have my Series 6 and 63 are inactive. In fact, it's been 3 years, so I don't even have them. I'm studying for the 65 right now. Really excited about that. But don't confuse your savings account with investing. A checking account earns no interest, which means it doesn't even track with inflation, which means you're losing money. So if inflation is 4 to 7%, 4 to 8%, or 3%, or a year, or whatever inflation is, and your checking account earns you 0.002% or nothing, you're losing money even if you never spend a dime. A savings account, all depending on how much money you have in it, like $100,000, $200,000, all depending again on your 6 months times 6, your 6 months or 12 months. Beyond 12 months, it's too much to sit in that account. You might be earning as much as 2%. Again, doesn't track with inflation, not even breaking even. If you never spend a dime, you are not investing in anything. I'm going to go a different direction with you that you're not going to recognize. You really need, if you're going to invest, you should invest in human capital. It'll cross lines here in a minute, so you'll understand from the language standpoint that you understand. In other words, when you invest in human capital, that's me, that's you, that's an individual person who has a business idea, that's buying a security. A security is an interest, an equity interest in equity or debt, actually, an equity interest in someone or something. So if you own General Motors and you go to the stock market and you buy equity in General Motors, or buy a piece of stock in General Motors, you now have an equity interest in General Motors. Or if Shaniqua or John or Mary or Twan has a business plan and some experience, you could buy equity into them. That's investing in human capital. A highly risky venture if you don't have the right team. But if you have the right team, or if you're going to help John or Mary put together the right team, it can be highly profitable. But if you don't want to get that risky, you could buy a Coca-Cola stock. Now we're investing. Holding onto your money in a savings account or even a 401k, which is a retirement account. This is what the retirement account says in most cases. A retirement account says you put your money here, the company is going to put a certain amount of money in there as well. Now I'm going to change it up on you a little bit. What a retirement account actually says is, we're not going to pay you all of your money. We're going to put the employer, we're going to put this money in here for you, and then we'll give you a portion of your income, and we're going to put this money aside because we're getting tax advantages. You're getting fees for the management of your money. So even the money they're putting in, you're not getting back. If you're fortunate, you'll break even, leaving the money in there. And if you're really fortunate, you'll turn a small profit, but it won't be to the extent that you can retire and live forever on it at the same rate that you're living now. I remember working for this bank, and I was making quite a bit of money at that time. It was considered quite a bit of money, and I had a certain amount of money in my 401k, and I didn't think about it, but I was day trading, and I lost the money so quickly, and I had this plan. So I bought these really expensive shirts. I had 2 cars. So I traded in 2 cars to buy one nicer car. So I created debt there. Then I bought this stuff and I created debt there. Or taking money out, create debt there. And I started day trading, and I lost that money in the span of, I want to say 3 or 4 months. Because money is not equity. I tried to buy equity with it. I'll share the point with you in a minute. I tried to buy equity with the cash that I had in my retirement account, but, and here's the point, I still had to pay taxes, so I found myself in a tax situation because I took all the money. I didn't take the money minus the taxes, so I had to pay taxes on that money, plus I experienced losses with the investment. That's the part that everyone is really scared of, because they're unfamiliar with how the systems work, and the tax liabilities can be humongous. So it's about understanding how the system works. I want to help you. And this is how I help you. Or you can help yourself. You can take the advice yourself and do it yourself. Number one thing, don't make a move without a good team. If you're so blessed with a certain amount of money, you need a financial advisor. Number one, write that down. Number two, you need an attorney, preferably an estate attorney. Write that down. I gave you two things there, a financial advisor and a state attorney. Number three, you need someone who knows how to create strategies with insurance, real estate, and securities. And that is not necessarily your financial advisor or your estate attorney. You need someone like me. Here's the reason why. If I had my securities license, a lot of things I couldn't tell you because of the laws. But I have an insurance license, so I can create insurance strategies. I can also put the right people around you so that you can create real estate strategies and security strategies. See, saving is not investing. Saving takes no strategy. Investing is living life intentionally. That takes a strategy, that takes a team. Thank you for the opportunity to speak into your life. And I pray that you do well. And I'll talk to you again soon.